All right. Good afternoon, everyone. Thank you for joining us here at Fogel and Potamianos presents the 2026 M&A and Alternative Investment Forecast. We have an all-star panel today of hedge fund, investment banking, and legal experts that will be contributing their insights and the forecast for 2026. This will be recorded, so if you can't stick around for the whole thing, that's okay. If you've registered, we will go ahead and send out the recording as soon as this is done to everyone who is registered. Some of the topics that we'll be covering today are the macro effects of markets, the interest rates, political economy, and international affairs, and how all of that is affecting the forecast. We will be talking about private fundraising and deal flow, M&A deal activity and trends. And we are so excited to introduce our all-star panel today. We will start with none other than Caesar Bello, who is one of our regulars here on our virtual panels. Thank you so much, Caesar, for joining us. Caesar he leads the litigation finance practice at Corbin Capital, a multi-strategy alternative asset manager with 10 billion in AUM. And prior to joining Corbin, Caesar worked at Skadden, Arps, Slate, Mager, and Flom LLP and Ivy Asset Management. He also had a very long career as an attorney before joining the investment team there. Caesar, why don't you tell us a little bit about what's going on in your neck of the woods right now?
Sure. I think like everyone else, we're watching things closely and paying attention. There's a lot going on in the world, right? Which, tends to make its way into people's portfolios, whether they want it to or not. So, keeping our head down, staying focused.
Very good. Thanks so much, Caesar. Next up, we have another regular, Jason Somerville. Jason is a partner in a boutique advisory firm, GW Partners, where they advise primarily consumer-focused founder-owned businesses in the lower middle market, mostly advising on the sales side, M&A work. Jason, why don't you give us a little bit more about you and what's going on in your world right now?
Sure. Thanks, Christina. Yeah, as you said, we spend most of our time advising founders in the lower middle market in the consumer world. So we do quite a bit of strategic consulting as well as sell side M&A work. And it's an interesting time, I think, for M&A across a number of sectors. Consumer kind of is having its own set of I'd say issues at the moment in terms of deal activity, but I think that's kind of broadly the environment in M&A. We think we've seen it for a couple years now, where we're just not seeing huge volumes. We're kind of bumping along similar to 23, 24, 25. Probably we can get into the forecast of 26. Probably not a lot changing there. We're seeing, some larger deals, which kind of make the total volume from a dollar standpoint look a little bit, I'd say, better, frankly, than it is if we're gonna judge better by being, more volume. So I think that the environment is sort of cautious. I think the criteria has gotten more pointed, and I'd say there's more things that a buyer wants to see before taking some risk in an environment that I'd say feels a little bit harder to predict for a number of reasons, which I'm sure we'll get into today.
Yes, thank you so much, Jason. Always so glad to have you. And also, we are so excited to introduce Corey Mazza of UBS Private Wealth Management. He joined UBS in 2021 as a senior vice president. In his role, Corey advises clients on a range of personal wealth matters, including investment management, pre-transaction planning, portfolio construction, and estate planning. Some other really cool things about Corey: he played football at Harvard and professionally in Europe. He also served in the Marine Corps for a few years. Corey, we're so glad to have you. Why don't you tell us a little bit about what's happening in your sphere of influence?
Uh, Great to be here. Excited to team up with Jerome and team and these other all star panelists. I'm one of the managing partners on a team of 16 here at UBS. We oversee around $5 billion of assets for our clients. About 78% of them have gone through a major M&A event at one point in time, and so we really specialize in guiding them on the front end of that liquidity event through the transaction and managing the assets afterwards. We provide different experience depending on what the client's looking for. But for a lot of our clients, we are an outsourced family office. So the topics here today on mergers and acquisitions, as well as alternative investments, which we're heavy users of, a lot has been very topical and what's been going on both geopolitically and in the private credit markets as of late. So it's been a great time. We're staying busy and really working side by side with clients as deal making activity is picked up.
Very cool. Well, so glad to have you, Corey. Next up, we have Jerome Fogel, co-founder of Fogel and Potamianos. He's known as a deal maker and innovator in the legal community and represents successful corporations, venture and hedge funds, and sports superstars. Jerome has a 360-degree view of deal making as he represents emerging companies, raising capital, venture funds, deploying capital, advisors and investors, and private companies in mergers and acquisitions. Jerome, tell us what's going on in the legal sphere these days without giving us too much before we get into our conversation.
Sure. No, great to be here. Great to be with just a phenomenal set of panelists here and perspectives. I think generally M&A and venture, our clients are heavily involved in on the private side, we're seeing it thawing. I think what we are seeing is a lot of buyer selectivity and a lot of creativity needed in deals. So it's really incumbent upon lawyers to be creative and finding ways to bridge gaps, whether it's valuation, um, whether it's financial or other risk management gaps in these deals. And yeah, and for the venture, we're definitely seeing a small comeback here on the private side. So we're seeing LPs getting involved in high caliber, high potential deals. So to the extent that our clients are involved in some of these really desirable deals, there's a lot of LPs getting interest. So I think we're seeing a resurgence on the private M&A and venture side, which is I think relevant to 2026.
Awesome. Thanks so much, Jerome. And we have my co-moderator, none other than Constantine Potamianos, who is the co-founder here at F&P and is also the head of our corporate practice group. Constantine is an experienced business lawyer who has counseled public and private companies on a broad range of corporate and securities matters, including business entity formation, public and private offerings, mergers and acquisitions, securities registration, SEC compliance, and the list goes on. He also has an impressive military background. Constantine, give us a 1-minute snapshot of what's going on and what you're seeing.
Well, I think we're seeing a lot of uncertainty out there, and a lot of volatility as a result. The bad news is that causes people to kind of step back and try to reevaluate and understand the environment before moving forward. The good news is, and our panelists can chime in on whether they agree with this or not, volatility and uncertainty sometimes opens the door for a lot of opportunities that may not be there in a steady state environment. Nonetheless, the markets traditionally like stability, so this is an uncertain time, and this is part of what we'll be discussing today.
I love it. Thank you so much, Constantine. And my name is Christina Lowe. I've been part of the F&P team for 4 years now, and I'm very excited to be here. This is one of my favorite things that we do, and I think we're going to just go ahead and kick this off with Caesar. And really what's trending in the headlines right now with Blue Owl, and maybe you can just give some insight into the private credit sphere there, Caesar.
Yeah.
Let's start there.
Yeah, sure. So, I think with any transaction, right, you want to understand the ecosystem and, how the parties play with each other and what their motivations are. So in these large direct lending funds that lend to sponsors, right, that's typically been a good business, but it's been a very competitive business. So they're all fighting for the next deal, right?
By the
So
way, Caesar, for the benefit of our audience who may not know what Blue Owl is, can you take a second to just bring them up to speed?
yeah, it's a large asset manager. They do a bunch of different things, but in particular, they have a large, direct lending product where you typically finance, good high revenue, high EBITDA companies, the types of companies that get bought and sold by private equity shops.
And we're
Uh,
talking about the private credit market that we've been seeing a lot of in the news lately, right?
yeah, yep, right. They play a decent role there. Um, but back to sort of understanding the players and the conflicts of interest potentially, right? So Blue Owl is fighting with Apollo and Ares and Golub and whoever for the next deal, right? So if one of their loans is in trouble, and as a lender, you shouldn't be in the lending business unless you're ready to enforce and do what you need to do to get your capital back. Are they really going to, go to the mat and push very hard against a borrower that isn't doing so well and maybe burn that private equity relationship, right? And even if they wanted to, can they? What tools are available to them? Because these deals have been very competitive to win, and it's created a bit of a race to the bottom in terms of covenants. So they tend to be very covenant light if they have any covenants at all, frankly. So that is the bars are perceived as very safe. Think 100 million EBITDA companies, and the business worked well. They made a lot of money, and everybody's happy getting a 10% return with not a lot of volatility in the mark, and that's okay, for the most part, right? It has been, but um, you know, enter sort of AI, for example, and there's been more concerns around SaaS companies getting disrupted and disintermediated, and that narrative starts to fracture a little bit, right? So just like any other asset class, you can lose money, and you do, and sometimes things are not as safe as they are. So some of these products, like Blue Owl, investors want their money back at times, right? So um, they are forced to sell things that maybe they don't want to sell at that particular time. And it's important when you're looking at these vehicles that they have the right asset liability matching. So and people focus on default rates a lot, for example, but really you should be more focused, I think, on recovery rate, right? Because you can have a bunch of loans that trip a default. Maybe it's not a big deal. Maybe it's a chance to actually make some more money and charge a higher default rate, and it's a foot fault, and or maybe it is a real default, but if you recover 95 cents on the dollar or maybe par, then that's fine, right? You can have a lot of loans like that, and it doesn't matter, and it's not a big deal. But even if you have a few defaults, but you have really deep distress situations where you take a donut or recover back 20 cents on the dollar, that's more of a problem, right? So is Blue Owl sort of the canary in the coal mine? Is it the beginning of a down cycle where you're starting to see kinks in the armor for these, private credit sort of sponsor lending vehicles? Hard to tell, probably not. People overreact to things, but I do think there's some products out there, some of these interval funds, for example, where maybe the investor base is not as educated on the terms and the mechanics and how they're supposed to work. If you have a more retail investor base, it's not as sophisticated. Do they know that this is not a super liquid product where you can just get your money back whenever you want, right? So hopefully, whoever's advising them, is keeping them well informed. Um, for us, I mean, we play a little bit down market, right? We like covenants, and we're trying to make 15% plus. So you need all the covenants you can get, and it's riskier historically. In particular, where I play in sort of specialty funding and litigation finance, it's not to say at all that it's easy and risk free. Far from it, but it is a little bit more uncorrelated. You are getting paid more for the risk, and we do have I think a little more levers to pull. Uh, but importantly, everybody that invests in our fund knows it's a 7-year vehicle, and you're not getting you can't get your money back in a quarter, right? So a lot of those issues kind of go away, which is helpful. The problem is oftentimes in the news cycle, like everything gets lumped together as private credit, and private credit can be a lot of different things depending on what you're doing, how you're doing it, ABS, whatever, right? So I'll stop talking now.
So what's your overall conclusion, Caesar? What I take out of that is that private credit certainly isn't going away. It's adjusting to circumstances, and of course, every firm that's engaged in it engages in it a little bit differently. But are
Yeah,
you seeing anything in particular percolating through the industry in terms of approaches to private credit?
I mean, I think some of these events have got people a little spooked, right? And some people are definitely, ready to take their ball and go home. Is
Mm.
it is it going to have a broader kind of contagion? Hard to tell. I don't think so. But there have been, to be fair, sort of a proliferation of vehicles where, maybe the asset liability matching isn't great, right? And you know, that those things tend to um, ebb and flow, right? Oh, the market doesn't like this type of vehicle anymore. Oh, this one is back in vogue, and then we do the same thing again. SPACs, no SPACs, right? So it's the way of the world.
Things come and go every few years. I've been watching SPACs come and go for 30 plus years. Um, let me flip it a little bit to Corey, if you're comfortable answering this question, Corey, which is, okay, we've gotten an originator's view of the market from Caesar here, but from your perspective, dealing with multiple clients, et cetera, what are you seeing as the trends in the alternative marketplace, and what are you seeing clients looking for in that space? And if you think I phrased that wrong, or you think there's something else that's important to bring up in that context, please feel free to.
Happy to. I think I'll focus first on private credit since it's a continuation of the conversation, and go back up to alternatives as a whole for some of the family offices we support, as well as the individuals. On the private credit side, I think these redemptions are going to end up being a liquidity test, but not a systemic credit crisis. When you look at credit quality and across the book of loans from the major players, as we're talking here, through Ares, Apollo, Blackstone, um, you know, Blue Owl got hit a little bit harder when people started looking more closely at their exposure to software in their loan book, and then looking at the rapid advancement of AI in just a short period of time, and how valuations within the tech sector might be impacted, and software explicitly might not have factored that in the way that it priced its loan book. But receiving partial redemptions, I think, is going to change investor psychology a bit. It's something that we preview with every client before we enter into one of these continuous fund vehicles. There are quarterly liquidity windows, but that doesn't mean we necessarily redeem all of our allocation out in any quarter period of time. And the pressure is pretty concentrated, not evenly distributed. When you look at the redemption of 7.9% of BCRED, I think it was like around 11.4, 11.2 for Ares and Apollo. BCRED honored 100% of the redemption request, and it looks like Apollo and Ares are going to honor at the 5% redemption amount. But I think the idea that all of the loans within those funds are heading towards a cliff is just not true. So I think over the next 12 to 18 months, it's going to be more of a negative investor experience than a negative investment outcome. There's just a lot of income generated in these vehicles that where the headlines are going to be pretty sensationalized, and I'm very curious to see, especially with a large fund like Blackstone Private Credit, what the redemption percentage looks like going into next quarter. On the alternatives, zooming back out for alternatives as a whole, you've seen clients a greater demand for these continuous fund vehicles, especially on the private equity side. Funds through KKR, Blackstone, Ares, secondary private equity funds. the idea of not going into a traditional drawdown structure, having access to liquidity windows has been appealing for a number of clients. I think when we look at the efficiency of compounding growth within some of these funds, getting every dollar in on day one, it offsets some of the difference in the return from a traditional drawdown private equity fund that might have a 10-year commitment with 2 1-year extensions, where the capital is not completely drawn until year 2, year 3, year 4, and then we're returning capital shortly after. So the demand has definitely pushed in that direction, and we are big users of funds like those. And then private real estate has slowly been kind of inching its way back up, coming out of the rapid increase in rates over the last few years. But something interesting we were talking about as a team last week, we came into 2026 expecting, with the market pricing in a couple rate cuts, and on Friday, for the first time, we saw the market price in a rate hike in 2026. And just given everything that's going on geopolitically, and new incoming Fed chair that has been made very clear by our commander in chief that short-term interest rates need to be lower. It's a interesting position we are now in as this war in Iran continues on, and we could be in a position where you see inflation tick up and really hamstring what they're able to do and impact private real estate markets as well.
Thank you very much, Corey. Let me turn it over to Jason. Jason, you're very good at creating a client pipeline for people like Corey, because you really help a lot of businesses exit successfully, leaving them with a pile of cash to give to folks like Corey to multiply it from there, and folks like Caesar. Now, with that said, at your level, kind of what are you seeing? What are the trends that you're seeing? And what's kind of the mindset and outlook of your clients at the moment in terms of the markets and alternative capital and kind of what they want to do once they cash out, if and when they cash out?
Yeah, no, good question. I mean, I'll hit kind of the first things first there, Constantine. Mindset. I would say, obviously, we deal with founders. You're going to have a little range of mindsets because you're dealing with individual people.
Sure.
And I would say, but if I were to say on balance, a lot of the founders that we speak to and work with are feeling like their best use of their time, energy, and kind of focus and capital over the next couple of years is to grow their businesses, improve them, and think about exits, a little bit down the road. If I had to kind of ballpark it, I'd say maybe it's 75-25 right now. 75%, are thinking about, hey, this is still my ultimate goal that I want to reach, but I'm not really thinking it's going to be a great time to go do it the next year or two. And obviously individual situations can vary there, right? So, and I think just to kind of piggyback a little bit off of the conversation so far, it's just, whenever we have volatility, we've had tariff volatility, we've got now, war volatility, we've got these kind of, so far, I totally agree with Corey and Caesar. I think so far the private credit noise is mostly noise at this point. The noise seems to be getting a little bit louder. I think that, like most cycles in credit, what happens is, the first 80% of the curve, everybody's behaving. And then the last 20%, you get some people behaving badly because it gets overheated and they stretch and there's too much leverage and people push. And my guess is if there's any fallout, you're going to see it's going to be a pretty small percentage of just portfolios where the market got overheated and people just stretched and they just got a little bit loose with their standards, and ultimately it came back to bite them. And that's the same story of like literally almost every credit cycle in history of, and going back to like the most recent of '08, just it started out, well, okay, mortgages, right? Nothing wrong with that. Can't go wrong with mortgages. And then all of a sudden we figured out a way to go wrong with mortgages, right? So and it's because people just got crazy with it and just started to push the envelope. But yeah, and I think the question is funny about kind of what do these founders think about post exit? And I think that ironically, I'd love to hear kind of Corey's view if he feels the same way. I think most of the time when a founder exits a business, literally, if you were to calculate their net worth the day before they close, 90% of their net worth is in that business, right? It's in the value of that business. And then the next day, it goes from 90% in the business to about 90% of net worth in cash, right? And ironically, I see people going from more often than not, like, because they're taking a lot of times, and we work with founders a lot to sort of help them understand their risk. Because a lot of times founders don't actually even really understand their risk profile. They're just plugging away and they just don't even think about it. But it's extremely high risk, right? Having your net worth in 90% of it in one very illiquid, most of the time, private company is not what most asset managers would recommend. But so then what we see, like when they talk, they want to kind of go flip and go way more conservative once they go from being a business owner to having a pile of cash to invest. And I'm sure, guys like Corey, when they're having conversations, the guys still want a good return, but I would be surprised. Corey might surprise me. But if it isn't heavily capital preservation type discussions, rather from that point forward versus, hey, let's go out and hit just grand slams and put a lot of capital at true risk.
I think the running joke is no one wants to get rich twice, and the idea that these business owners or founders or key executives have had such a preponderance of their wealth tied up in this illiquid uh, private business. The business is not being marked on a daily basis. They know the inherent risks of the business. They know where they're vulnerable. They know that when they've had to withhold distributions to themselves or double down and really commit to growth. When they go through that transition and the wire hits, and we talk about it in meetings leading up to it all the time, and it's still to try pre-experience that feeling. All of a sudden, the way that you've been supporting your lifestyle, what you've been running through your business is no longer the case, and we are going to be generating that income from the portfolio. And when we make that transition, we always start more conservative from our standpoint. If we have a long-term strategic asset allocation that has more risk in it, we want to grow into that because it is a whole new skill set that they got to navigate and managing expectations there. And it's something that when we spend time with people going through that, everyone seems to overestimate the amount of risk they are comfortable with until that first drawdown. We had the case in early April last year where a client received a big wire right before the tariff tantrum. And we talked about, oh, I want to be in 60% equity, and we walked through all of it. And then, we went through a phase-in plan where it was going to be spread out over several months. And we went through that first bit, and you could feel the client change their demeanor quite a bit on April 2nd when all of a sudden equity markets pulled back in a large significant way. Look, if you look back historically and mathematically, and you'll see it from the Warren Buffetts and the other just incredible investors throughout history, you are better off putting all of your money into your long-term asset allocation on day one. We are fallible human beings that suffer from behavioral psychology biases, and it is that loss aversion is real. And finding a way to match goals and objectives with asset allocation and really customize how we get there, that's the bulk of what we do on a daily basis.
Nice. And let's give Jerome a chance to kind of also talk a little bit about what changes are occurring out there that we're seeing from the legal landscape for the alternative asset and M&A market going into 26 or going into Q2 at this point.
Yeah, of course. And obviously, I always want to get Jason's full-throated 2026 M&A analysis. So that's forthcoming. I'd say
We will.
from our perspective, there's a lot of buyer selectivity. They have choices, and they're looking for, crown jewels. They're looking for, if they're private equity, they've got a platform and they're looking for just add-ons or tuck-ins. So they're kind of being conservative. You've got strategics that are, they're grinding on, price and terms because they have an advantage. You've got corporates that are unloading some of their brands that are underperforming, or maybe a corporate, bought a brand, it's not really performing well, that now they're going to go back out to market with it. So there is activity on the fringes, and I think M&A and private M&A is strong. There's a lot of creativity involved, but it's still there. I would say on the legal side, there's just one really interesting case that just came down. It's Fortis Advisors versus Krafton Inc. So Krafton's a large Korean video game maker, and there's a company called Unknown Worlds Entertainment, and they put out they put out the sea aquatic like underwater submariner game that's very popular. But basically, the way this went was it was a $500 million purchase. There was a $250 million earnout. And what happened was the acquirer's CEO felt uncomfortable that the earnout was going to be paid based on the accountant's projections. So he started to use ChatGPT to investigate strategies to essentially terminate the earnout. And he had a whole concocted strategies, takeover strategy. What happened was, number one, the strategy didn't work, but number two, all of his conversations, his chatbot conversations were discoverable, all of it. So right now, the way this case stands is that the judge has ordered essentially the earnout period to open up again, and have placed the key employees back in those positions who were terminated wrongly for cause. What I'm going to foresee is a wave of busted deal litigation where a lot of CEOs and their top executives are using LLMs, which are not privileged, to investigate how to circumvent deals. And so we're going to see a lot of this coming up. And so advice for sellers is, if you suspect something's going on and it's the big enough, litigation case, that's a discovery area that's ripe, that's going to be very favorable for you. For buy side, I think the advice here is, be a good deal maker and don't do this, but also you work through your attorneys and not through these public forums when you're investigating, possible strategies. So I really foresee a lot of this going on, because you're going to have people from the last 3, 4, 5 years that were using, AI to investigate legal strategy. And so it's going to be really interesting popcorn time coming up.
So what you're saying, Jerome, is AI is not really your friend until it's ultimately able to pass the bar and get licensed in every state. So still go back to your human lawyers when you actually want advice.
That's right. That's right. And yeah, the case in point of the CEO thinking he was going to save $250 million, and this caused a quicksand for his entire company.
Hey, Jason, let me go back to you for a second, talking about M&A here. So you touched on the fact that most companies that are contemplating M&A are really kind of looking a little further down the horizon. But with respect to those that are moving forward now, that are interested in moving forward now, what are kind of like the key factors that are most important in today's environment?
Yeah, it's a good question. I mean, I think one thing I mentioned at the beginning, Jerome kind of mentioned it a minute ago too, is this idea of kind of crown jewel sort of. I mean, what I'm seeing is just the bar has been raised at this point. I mean, versus again, it's all cyclical too. This is not the first time these things all happen, but we're in that part of the cycle where buyers are they're very they're very picky. They want to. There's still lots of companies and funds and so on who want to do deals. They really do, but they want to do deals for things that they really, really love. So it's like, hey, it's got to be a 9 or 10 out of 10, and that's not, I mean, that's a somewhat of a subjective measure, as I think probably everybody here fully appreciates, is it's not always, oh, well, I have a top 1% EBITDA in my, peer group. Well, that's one bullet point. I mean, there may be other issues which knock you down, right? And it's also sometimes it's beauty in the eye of the beholder, as you know, too, Constantine, is
Yeah.
it's if the buyer says, look, this is a 9 or 10 out of 10 kind of opportunity for us in particular. This fits really well for us, and this makes a lot of sense. Those kinds of deals get done, and I think what we run founders through all the time that talk to us and say, hey, what do you think the reception, if we went to market, what do you think the reception would be? And we have to be just brutally honest about like what the market's going to say. And what we try to do is say, hey, like if you're not at that 9 or 10 out of 10, or there's not a universe of potential acquirers who would maybe put you in that bucket, here's what you need to do to get there, right? Here's kind of the places where you need to focus. So yeah, I think that's what it is. I think the bar's just been raised. I think, not to go down an AI rabbit hole, but one of the things we talked about, I think, as a group ahead of time here, was one of the reasons there isn't more M&A right now is because, when allocating capital on balance sheets, more companies are allocating capital towards AI and AI sort of build outs, not M&A. So kind of AI investments are stealing capital from what might normally be used as part of an M&A strategy. That's also kind of a part of what's happening as well. And as well as just the idea of we're in this world right now where AI is a very muddy water, and most CEOs aren't quite sure what it's going to do for their business. In fact, I was actually just reading an article today, which I had not heard, that the former CEO of Coke and the former CEO of Walmart in recent interviews said part of the reason they left was because of AI, because they felt like that leaders, there needed to be a new person in the seat who was going to be very AI, kind of much more interested in understanding and building AI into the businesses. So that's kind of an interesting little snapshot, right? As you're seeing how what might be going on in boardrooms and all over the place of okay, where are we going to put this investment capital? We're going to go make a big acquisition, or are we going to,
Yeah,
put half of it into AI?
that concept of AI stealing budget from other stuff is something we're hearing a lot, right? So, people being freaked out about what's happening in SaaS. If you talk to SaaS people, they'll actually say it's not that AI is going to replace us, because the switching costs are very high once you've uh, adopted our platform, and you need our support, and there's daily interactions with our team, and you spend a year training your people on that, right? That doesn't get switched off overnight. But it's that going forward, maybe some of their budget is being more allocated towards AI than towards next year's SaaS product, right? So it's an interesting framing about AI having an indirect but still meaningful impact. I hadn't thought about it in terms of M&A too, but it keeps coming up.
Let me throw out a thought, Jason, which is, you know, in terms of important factors in 2026, for your middle market clients, et cetera, that may not be heavily involved in AI or integrated AI, maybe part of that value add is in advance of going out to market, thinking through kind of internally a comprehensive AI plan, meaning what can my business do with AI? How do we integrate with AI in the sectors that we operate in, et cetera? What do you think of that, even if they're not actively using AI at the moment?
Yeah, it's a little bit of the new kind of ESG at this point bullet, right? And I think what we try to do is we try to position it so that, all right, is this just some like window dressing BS, right? That we're talking about, or is this real? Like, are you really, is one of your, call it, beneficial core competencies that someone might even acquire and look at it as acquiring a core competency is really understanding how to at least integrate what the current forms are into the business with some demonstrable kind of effects, like positive effects, like efficiency,
Right.
not theoretical, not, kind of all just whiteboard stuff. Like, what are you actually doing? So yeah, it's 100%. I mean, if you're going to go out with a deck on a deal, usually you're going to want to talk about how's this company using AI and how do they envision using it. It's just one of these things. It's on everybody's list that they're going to want to talk. They're going to want to talk about.
Okay. Okay. That makes complete sense. Um, we're going to go into Q&A here in a little bit, but before we do that, I also wanted to give you guys, I mean, we've all talked about the uncertainty in this market, and of course, people get a little nervous about that, which is natural. But I want each of you to think about and maybe give me three opportunities or positives that you see in today's market. Um, and Jason, since you're the first to nod, let's start with you.
Well, I've said it on these webinars before. It's like volatility is actually usually it's an opportunity. So I see it in a short term on a short term basis. I think there's a lot of trading opportunities, right? Um, I mean, even just uh, going outside the box here a little bit, even just like looking at where all the shorts came in when Brent hit 110. It's like, okay, you could see the shorts start to really come in. So when you're talking stuff like that, there's always trading opportunities with volatility if you have the stomach for the roller coaster. There, I think that, look, in spite of, totally agree with Corey, it was a surprise to see all of a sudden now we flipped a little bit, and the odds of a rate hike here towards the end of the year are actually on the board. I think regardless, we're gonna have pretty steady rates, I think, for a while. And I think that the longer we can do that with maybe, hopefully, a dovish kind of bias with the new Fed chair, that will help promote asset prices. Gotta be careful though with, inflation. Are they dollar denominated and are you hedging? But so I'd say I think the interest rate environment, generally speaking, will be positive for investors. It will be hopefully stable to hopefully a little dovish with the new Fed chair. That's the hope. Look, and I think that there's still part of the reason why we saw private credit go from a $300 billion asset class in 2008 to a $3.3 trillion asset class in 2026 is because there's a lot of capital, and there's still a lot of capital that wants to find homes for, good return. So I'd say, it's funny if we did this webinar at the exact same time 5 years in a row, I would say all 5 years in a row, there's a lot of money on balance sheets and there's a lot of money in dry powder and private equity funds that wants to find deals. You gotta put something out there that's really compelling.
Thank you,
So
Jason.
that's my list, man.
That is a good list. And Caesar, I think he teed it up for you by concluding talking about the private credit markets. You come back and tell us now what you see as three positives and three opportunities in the marketplace.
Yeah. Well, I'll give you as many as I can. You put me in the spot here, but one obvious one for me uh, is, and personally, right? Because I live in a very niche um, subsector of a subsector, right? So we're doing credit and litigation finance. Is anytime there's this kind of turmoil, it's a good reminder that you want a balanced portfolio that is defensive and diversified and uncorrelated. And look, we haven't had a real recession in a while, right? Has the recent history has been some blips and some volatility, but things end up okay. Eventually, at some point, we're going to have a real one here, and it's going to hurt. And you want to operate under the assumption that things aren't going to stay rosy forever. So whether, it's 10% of your portfolio or 20 or 30, everyone has their own risk appetite. I think anytime these things happen, just crystallizes that you need some balance in your portfolio. And, a lot of times for a million different reasons, that doesn't exist. So on the broader private credit markets, I don't know that there's that much to glean right now. AI is sort of lurking behind the curtain, and a lot of this stuff, when it happens, it happens really fast, but the adoption and disruption, but it feels like it always takes a longer period of time to get there than you think, right? So like none of this stuff is, I think, really happening overnight. And when it does, it'll probably hit us like a ton of bricks. So, prepare accordingly, I would say.
Okay. Uh, and Jerome, how about you? We deal across a number of sectors, and we talk to a number of people. What are you seeing as three possible opportunities, possible positive trends in the marketplace right now?
Yeah, I think first off with venture is basically taking a time machine 10 years in the future. So there's a lot of bets being made right now. And so, venture was out of favor for a couple of years, but this in tough markets is when some of the best companies are formed. So, we've got clients that are making some selective bets on the future, and again, they're going 10 years into the future. So I think there's opportunity in venture for some of these prime kind of futuristic candidates. And it's not just AI. There's all kinds of, I mean, there's computing, there's all kinds of stuff out there that's very interesting. So that's one. I think second is there is going to be opportunity in private M&A. You've got PE funds that their LPs want return on capital, and they're going to need to sell some of their assets to get their LPs to re-up for their new funds. So that's going to create, a lot of liquidity in the market. And so there's going to be opportunity in private M&A. I think a lot of the lower middle market and mid market, I think people are going to be chasing alpha there. So you're going to see some, private equity kind of coming downstream and fighting for some of the same deals. But I do think that there's gonna be some private M&A opportunities. So I think we're positioned really well for that. So I think that's the second thing. I think the third thing, I really love what Corey said, the rich don't want to get rich twice. So I think it's like I really think that entrepreneurship is our country as a whole is very entrepreneurial, and I do think entrepreneurs are always finding new solutions, innovations, and finding opportunity when things may not, being curious and open when things may look bleak. So I think it's always going to be an opportunity to create new companies here and create value and bet on yourself. And so a lot of our clients do that, and we help support them. But then once they do it once, I think it's really smart. Like don't go for broke again, right? Like, don't try to get rich twice. I think that's good advice.
And Corey, I saved you for last on this because you are the master of ferreting out opportunities and understanding trends in the marketplace. So tell us, what do you see as some positive trends in the marketplace and some opportunities that you guys are seeing?
Great. I think the longer this goes on and with the war in Iran, the worse it's going to be for the economy. I think
That's
if you
not
see oil,
positive, Corey. Looking
I'm gonna get there.
realistic, but not positive.
I got a lot of my fellow Marines repositioning around the globe right now, and so there's
I
a
get
lot
it.
of there's a lot of emotions underneath the surface there. But I think look, an increase in oil prices with 20% of the world's oil supply flowing through that strait, it impacts GDP, right? Discretionary spending is now going to different different areas than what it was intended to for consumption. And so with that slowing GDP impacting markets, right? Like the opportunities lay in a few different areas. We've had more family offices buying physical gold in the last quarter than really ever before. I think our team bought over $30 million of physical gold to store in vault in just the last 2 months alone. You've seen clients trying to take advantage of the rally in the US dollar, and with a view of it weakening further into the future, and by expressing that through buying non-US equities. The On the tax mitigation side, volatility, like Jason said, is our friend, especially when you're expressing some of your equity exposure through tax loss harvesting vehicles. You have the regular vanilla ones like Parametric and UBS and Goldman Sachs. They all have Aperio. They all have a tax loss harvesting strategy where you're owning 200 to 300 of the S&P 500 names, and when Wells Fargo goes down 4%, you're trading out with Bank of America, maintaining a tracking error of 1 to 1.5%, but harvesting losses along the way that generate tax alpha. We've seen a greater demand for going into these levered tax loss strategies. So in this quarter alone, we've committed over $100 million into funds like those, where you're getting just accelerated losses, and some of them project up to 100% tax losses in the first 3 years, and being in this strategy, and essentially a long short strategy. And so the focus on gold, the focus on playing the US dollar pricing, as well as just tax loss harvesting in different areas. That's been the three opportunities that I'd say that have come to mind. We've been kind of surprised that we haven't seen clients play the duration trade a little bit more. We've been trying to manage our fixed income portfolios as we've seen the 10-year yo-yo up and down quite a bit over the last several months, not just from this geopolitical shock, but these things happen. 5 months down the road, are we still going to be feeling the impact? And will oil come back down to $60 a barrel? Probably not. But the market is able to withstand these geopolitical shocks like that very well, and in 12, 24 months, and the investment time horizons we're investing for our clients for, we feel pretty good about the way we're positioned.
Thank you,
This
Corey.
is such a great discussion. We're already at 12:55. Wow. And such amazing insights. And you guys have actually covered a lot of what would go on in the Q&A. So I think what we'll do is we'll just wrap it up with some of our final thoughts. We got about 5 minutes left. We do kind of popcorn style, but basically the question is, how is this year in M&A going to look different than the last couple of years? And any other final thoughts you guys want to throw out there that you think are important for people to leave with? Jason, you want to start?
Sure. Yeah, I think on the surface, it's going to look similar. Like if you just look at big headlines, how many deals are getting done, what's the dollar volume, I think it'll be similar. I think obviously we're going to see some big potential things going on that are AI driven. I think that will skew those numbers a little bit. I think that Yeah, so I think that last year it was very much like for a lot of sectors, our sector being one of them. Tariffs kind of were sort of the bigger volatility driver and kind of making everybody a little bit nervous and a little bit, just again raise the bar a little bit on getting deals this year. This year feels like it might be the Iran situation, might be the thing, right? So. I think it's going to be similar. I do. I think that I would say, if anything, it feels to me like, because we've kind of been in a lower volume environment now for long enough that it does feel like some of that impatience that Jerome was kind of alluding to is starting to kind of come through the cracks a little bit. I think also what you have is, frankly, business owners that, we went through a kind of in a lot of sectors, a valuation peak in like 21, 22. And they've kind of settled into maybe a little bit different multiple kind of environment and are okay with it, right? So more willing sellers, more willing buyers, probably a little more deals to be done, I think, on the margin.
Yeah, and I would say, a lot of it is going to be dictated by the war and how protracted it is. Feels like, our commander in chief is looking for an off ramp. He tends to react to things that impact the market. I don't know if there's going to be one here, in the way that he wants. But if that, resolves itself, I could see things really picking up. And there's still some other unknowns out there, but that'll be a big driver. And if it doesn't, if we're stuck in, a deeper sort of engagement, that's probably going to be negative, right?
Yep. Corey, any final thoughts there?
Yeah, I think like Jason and Cesar said, I think big deals are going to be more prevalent this year, but definitely more selective on the mid-market side. So kind of more of like a K-shaped M&A experience on the top end with those bigger deals. It's interesting because I think 2026, the hope was maybe that it would shift back to being driven by cheap money and the ability to do some more financial engineering with deals and using cheaper and cheaper debt as rates continue to come down. But if we are like Jason was saying, in a interest rate environment that's going to be a little bit stickier in this part of the curve, in the middle part of the curve, like it is right now, how that impacts deal making activity. Anecdotally, we have an investment banker we work with, and they had said going into Q4, they had more meetings in Q4 than they had the rest of the year combined, and very optimistic on coming into 2026. And so I'm curious. I got to follow up with that banker to see where we're at given the state of the world today at the end of Q1.
I'll give my final thought to Constantine. I want to hear from Constantine.
Oh, final thoughts. I think Jason's point is kind of the most valid one, which is we've had kind of a series of shocks to the market over the last few years, be it COVID, be it tariffs, be it now the war in Iran. We have, on a positive note, it seems we've been able to shake all of that off and recover pretty well, which is a testament to the resilience of the US economy. It's not to say that there aren't ups and downs, but it seems like the marketplace is getting better at adapting to um, this change in environment. So, and I'm not getting a sense in either talking to the panelists or talking to other folks that there's this dire feeling that the sky is falling. Which is not to say that circumstances can't change, but right now I still feel like folks are ultimately cautiously optimistic about what's going out there.
Very good. Well, thank you all so much for joining us today on FMP's 2026 M&A and Alternative Investment Forecast. Thank you to each of our panelists for joining us today. And to everyone that's attended, we will send this recording out to you. Feel free to share it with anyone you think will benefit from it. And if you need any help from us at Fogel and Potamianos, you can reach us at info@fpgeneralcounsel.com. We hope to see you on the next one, and have a great day, everyone.
Thank you,
All the
everyone.
panelists. Thanks everyone very
Thanks,
much.
guys.